Good morning, I'm Sam Ing from Farmers Insurance in Alhambra. I've been a insurance agent for farmers for 22 years already. Pretty much that's it, okay. And then later on, I think maybe in September I can tell you more about my family and things that I do.
Good morning, everybody. I know many of you know me. I've spent several decades here at this board, started my career right here in San Gabriel in 1988, so I'll let you count those years. And so I know people have been kidding me. I started as a dark-haired kid, and now I'm a gray-haired man. Thank you. I'm the agency owner at Allstate Insurance.
Good morning, everyone. My name is Michael Sang. I'm Farmers Insurance agent. I joined the policy in 2005. I'm house in Arcadia, which is the local.
Okay, well, thank you, and welcome. So first off, we'd like to start with Mark, actually. So you're the veteran here. Mark, what perils are normally covered under a home insurance policy, and what perils are not?
Okay. People always wonder, what in the world does your normal homeowner policy cover and what does it normally not? So you're going to be covered for things like fire, naturally, wind, hail, explosion, falling objects. Falling objects can be trees falling on top of your house, can be even ice debris off a winged airplane coming through as we're in a flight plan and whatnot. And as you see what's happening in Baltimore, believe it or not, if you're on one of your preferred policies on homeowners, riot is also covered. So, you know, somebody comes and riots and burns your house down. Fortunately, you shoot them. Well, there's a term. I didn't say that. But if you shoot them, there's no coverage for that. If you accidentally shoot them, possibly coverage. All right. So willful acts are not part of a policy, but anyways, and vandalism is also covered peril. Now, what people don't realize is that we're in an earthquake territory, so earthquake is an excluded peril from your normal homeowner policy, as well as flood. Flood is defined as surface water hitting the ground and coming back in. So those two are normally your main exclusions, but the other ones are what's normally under your present policy. Thank you.
Well, I'll direct this question to Michael. If a worker, though, a contractor, they get injured on the seller's premises, does that policy pay for the medical costs or any liability suits?
You know, normally when you hire a worker, they got to have their own insurance. So if something happened to them, which is not going to cover under the policy. But we do have a business liability, which is you needed to add it on that. So in case that something happened, which is going to cover.
Okay. What about landlord?
The rental protector, which is a cover. You know, rental protector, which is not only cover the people affected on your property, the same thing when the tenant get hurt on the property, which is a cover too.
Okay. Sam, Mark mentioned about earthquake insurance, or earthquakes not being covered. Can you briefly explain what is covered by the California Earthquake Authority policy?
Okay. In the California earthquake policy, we call it CEA. Excuse me. It only covers the structures of the buildings. So actually, it's a separate policy. A lot of the homeowners or our clients, they thought that when they buy the homeowner policy or the fire policy, it already included CEA earthquake policy, which is not. So you need to buy a independent earthquake policy. CEA is of course one of them, the biggest one. It only covers the structures. It does not cover the content of your house, your furniture, and everything like that.
About swimming pool.
It doesn't cover the swimming pool as well. But to me, okay, if you notice, the last big one was about 1994. So it's about 21 years already by now, overdue already. So you might be wise enough to get something like that, okay?
You want to say more?
I just wanted to comment on just the workers' comp or the general liability. I don't know if they have endorsements, but I know that many companies, unfortunately, it's super, super, super important. You guys as realtors that if you guys hire contractors, handyman, or anybody that's working on the premises, that most policies, whether it's a homeowner or landlord, exclude their injuries on the premises. So perhaps they have an endorsement with the companies that they represent. But as far as I know that consistently, your injuries sustained by workers that are working on the premises are not gonna have coverage. So it's really important to check with each individual agent that you're dealing with, because if you hire a handyman and he happens to get injured, they're gonna go after the sellers, because the homeowner policies, the landlord policies, most likely are gonna deny claim. Now, if the person is working there for free, or you're doing work and you happen to get injured and the person's not paying you, then there is gonna be some liability, there's gonna be coverage for you guys to be paid for your injuries sustained, or if a friend's helping and they get hurt, there will be coverage most likely afforded. But if that person's being paid by the owner of the property, most likely there is not gonna be coverage, and therefore you better make sure that they have their own general liability and workers' comp. I don't know if you agree with that.
Yeah, I do agree with you, and a lot of our clients do ask us about this question here. I told them actually, if they have a remodeling or something that they need to repair at home, I mean, big project, okay, not like those small projects. They can get the contractor to name them as the additional insured in the contractor's policy, so that in such a case, it will protect the homeowner as well. Now, if they were hiring someone to do the roof, and then I am the workers that work for the roofer, and I kind of fall down from the roof, the homeowner policy will not cover that workers, because the roofer is a tradesman. They should have their own contractor liability to protect their workers.
Okay, very good, thank you, that's very helpful. Mark, what's the difference between a specified limit policy and one with extended limits?
Okay, this is something I do, as if many of you have gone through my training courses, I teach a lot on, is that when you receive a policy in the mail or you're comparing policies, you see a dwelling amount or amount of coverage that each insurance company does, whether it's XYZ company. The problem with that is that each company either has what they call a specified limit, which what you see is what you get. So if I'm insuring Vanessa's house for $500,000 and she has a specified limit policy, the policy is only gonna pay up to $500,000 and that's it, not a penny more, all right? However, many companies, such as the ones that we represent, have what we call extended limits, meaning that they will pay an amount above the policy limits if there is a claim and the claim exceeds the amount that is shown. Companies do either 10%, 15%, 20%, 25%, or 50%. So essentially, it's really, really important for you to know what you are covered under your own policies, those of you who are homeowners. The easiest way to do that is don't worry about the percentage, but go ask your agent, hey, what is the maximum amount this policy will pay in the event of a total loss? And that way you will know the true value of replacement on your house. And people oftentimes figure out, well, why don't we just bill for replacement? It's because no companies go out and really determine what the actual replacement cost is. The cost is prohibitive, meaning that in order to get a true replacement value, we have to hire every tradesman to come and do a bid to determine the value. And because that is not economically feasible, companies have their own formulas that they determine replacement costs, and essentially it's their best guess estimate. So it's really up to the insured to figure out, is this amount I'm getting enough to rebuild my house? And that's why the companies give an extended limit, meaning a little bit of variance, so that if they're in the ballpark but they're wrong, at least there's a little bit extra to put on the policy.
Very good, because they asked us in escrow when we order insurance to get that extended replacement.
Right.
Yeah. Okay. Going back to Michael, can you tell us a little bit about why they require, or why an HO6 condo policy is necessary when the association has, Sam, when the association has a master policy?
Well, if I were a condo unit owner, I only own that portion of it. Okay, so this is like a 10-unit condo. I only own 1/10 of the interest on that. Now, the master policy is required to cover the whole complex, which is only cover the building only. If I were the condo unit owner, either I am a owner occupied inside that unit or I can rent it out to someone. Now, the condo master policy does not cover my own unit. It only covers the exterior only. Now, for myself, okay, say for my own unit, I have my furniture, my contents, everything inside there. And also I have my partition walls there. I think starting in 2009, if you ask Janet over there, maybe Oriana, I think the lender is starting to require, if you get a loan and you have a condo, they need a HO6 policy, right? Correct, right?
Yep.
And they need you to cover the wall inside there, which is usually about 20% of the appraised value of your unit there. It does cover the partition wall inside the HO6 policy. It also covers the liability if I were your friend and I go to visit you inside your unit and I trip and falls. Now someone has to pay me for my loss of wages, to see the doctors, things like that. Okay, that will also be covered as well. But I guess nowadays the lender is very aggressive. They need you to cover the partition wall to make sure all the kitchen cabinets, the flooring, all those will be covered.
Yes, yes. And if you present an offer for a condo, have your buyers get quotes on HO6 or walls gain coverage. You don't just say, oh, it's an HOA, they take care of it, because that's just really the
Common area.
the common area. So usually a lot of times we come to the last minute and we're like, but we need insurance, and they never got a quote, and it takes a little bit of time. So you might want to have them get some quotes ahead of time.
Another point I want to stress is, in the condo unit policy, there is a endorsement called loss assessment. Now, if I were one of the condo unit owners, I can be assessed by the condo association for a claim which the insurance will not pay for it. Say, for example, if there's a judgment come down and then we have to pay $200,000, judgment come down to the association here. There's 10 units here. Each unit will be assessed for $20,000. Now, the insurance won't pay for that from the condo policy, from the master policy. In the condo unit owner policy, HO6 there, you can get a loss assessment endorsement there. And they will, like some policy, they will pay up to $50,000 for that.
Okay. Michael, going back to talking about replacement costs, what's the difference between the actual cash value policy and the replacement cost policy?
Okay, in case something happen, you file a claim. Normally, insurance company, they gonna base on we call it ACE, cash value. But use for instance, it's 10 years the furniture. They might consider depreciation, which they don't pay you They don't pay you the HO value. They only pay you they're gonna take out the depreciation. But the farmer side, they will pay you the replacement cost. We don't take our depreciation out. So like 10 years old, the furniture, they pay you whatever the value is right now.
Mark or Sam, do you want to chime in?
Okay. Sure. I'll comment, but he wants to complete the sentence, then I'll comment on that.
Then also, when we're talking about the reconstruction cost, how to determine the reconstruction cost. The farmers, we use a 360.
It's not used companies.
Oh.
General
Let's
industry.
keep it general.
No, the general, excuse me. Which is we use a 360 engineering the system. They automatically calculate it.
Wait,
what.
I'm so sorry, Michael. We want to keep it general to
Okay.
all insurance carriers, not just
Excuse me.
your company.
really, bottom line, if you have what we call an actual cash value, it's basically that they will depreciate for items that are depreciable, such as your roof is something that has a depreciation schedule, your carpeting and things like that. And a lot of times people go, well, you have a choice even if you have a replacement cost policy industry-wide. So when the companies will pay replacement costs if you have a replacement cost policy only if you rebuild. But let's just say that my house burns down and I don't want to rebuild. Then generally across the board, companies will just pay you what they call the actual cash value. So you won't get a full, cost of what it costs to rebuild. So let's just say, again, using Vanessa as an example, if her house costs $500,000 to rebuild, and she goes, you know what, I live in, I don't know, Detroit, Michigan, and I don't even want to build a house, because even if I build it, I can't sell it. Hopefully nobody's from Detroit here. But she can cash out on her policy, and depending on what company she is, she's not going to get $500,000 if she chooses not to rebuild that. So that's what replacement cost, that difference between replacement cost and actual cash value is.
Okay, thank you.
Can I comment a little bit on the CEA though? Because you asked about the pool and all that. I don't know if you guys are aware, but the CEA was developed by the California state legislators back in 1996 after Northridge quake happened. Because basically under California law, it says if an insurance company is to do business in California, they have to offer earthquake insurance. That's mandated, all right? So after Northridge happened, I know a lot of people don't believe that because they don't like insurance companies, and I understand that. But companies lost their shirts. Basically, they lost, each of our companies even that we represent, lost all the premiums we collected for like 70 years and whatnot. So companies said, we will no longer do business in California because insurance commissioner, you guys mandate us to have insurance policies by the earthquake. So if you were doing business back in 95, do you guys, anybody that was a realtor back then, right? The only thing we could do was the California Fair Plan. It was a mess. It was hard to sell properties and close escrows because nobody was offering policies then. It was a tough time to be an insurance agent. And so what the California legislators did was say, we can't have this in California. It's a viable market. We have to have our real estate industry going on. So they developed this California Earthquake Authority that basically provides for earthquake insurance. And so what you have to do is that, for instance, if you're with another company besides the one I represent, you can't come to me to get this earthquake policy. You have to go back to that company, and then your earthquake policy has the same effective date period, and it has to match the same amount of dwelling. So you can't get a different limit. You have to match the same policy limits. And as Sam alluded to, it does cover the main structure of your house, and it's not for your little bit minor chimneys falling down or a little bit cracks. It's for major destruction. Oftentimes your deductibles are 10 to 15% depending on which policy you pay. So on Vanessa's $500,000 coverage, she's going to have to either come up with $50,000 or $75,000 of damage before the policy even pays a dollar out. And it's going to exclude things like your fences, your driveways, your detached garages, your patios, your pools. But what it does cover is the main infrastructure of the house.
Let me supplement a little bit. Now, the earthquake policy actually, I look at it should be for a major claim, major damage. There's a 15% or 10% deductible on it. Usually, I would recommend to get a 15% deductible because you just want the coverage to be there. Now, in case there's an earthquake, a lot of people, they were looking at, well, the government can help you, the FEMA can help you. I don't think so, okay. Now, to me, earthquake policy is for the middle class, not for the wealthy, not for the poor. If I'm pretty wealthy, Bill Gates, doesn't matter, I can rebuild just like that. If I was so poor, I think the government will come in and help the poor. For those in the middle class, we're sandwiched in here. So, so look at this here, there's several options here. When you rebuild, either you use your own money to rebuild your savings. You don't want that. You say, well, I can go to CGen or maybe Oriana to take a loan, but I don't think you folks will loan because it's a distressed properties, nobody will loan you. Now, what other option you may have? Either insurance or yourself. You use your retirement to rebuild or you don't rebuild. I think pretty much that's it though.
Actually, there's a misnomer that FEMA, the Federal Emergency, oh gosh, what was, yeah. stand for? Management Administration or something, whatever, that they'll come and step in and give people money, whether low income, high income, whatever income. The answer to that is an absolutely myth, okay? It's a false statement. And, sorry, my phone is funny. It's a claim, so it's okay. But, basically, the FEMA will only pay for emergency supplies and shelters for temporary. But there is no money for it to pay for any rebuilding. And it doesn't matter your economic condition. And a very simple way to test this is go look at Katrina and just bring it up in Google and see how many houses still are not rebuilt, all right? And what I tell people is, when they ask me, Mark, tell me whether or not I need earthquake insurance or not, because the government's gonna step in, you know? The whole thing is, if the government stepped in, then why was the California Earthquake Authority created? Because the government would be there to provide the earthquake. It's because the money is not there. And the second thing is, well, you know, let's say Vanessa's my client, and she's going, Mark, I can't come up with $50,000. As Sam alluded to the fact, if they go back, she goes back to her lender, and she already has a first position mortgage on that, they're not gonna wanna lend her money to another $500,000 to rebuild. But don't you think she'll have an easy time to come up with $50,000 line of credit to pay the deductible? And that's why I say, if you guys can afford it, it is, you know, for peace of mind, I know it's not the greatest policy in the world, but I always recommend buy the policy, unless you can afford to walk away or you can afford to rebuild. Oh, he's not here to answer.
Well, Mark, I don't think that she has to come up with $50,000 of deductible on that sometimes, because what they look at it is, so if there's a damage, say they will pay her, say, $200,000 of the damage. So they will minus the $50,000, am I correct, her deductible?
That is
and
correct.
pay her the net $150,000. Now, so Vanessa has the earthquake policy. Now, if she doesn't have an earthquake policy, she has nothing. If she has an earthquake policy, we'll pay her $200,000 minus the $50,000 deductible. She doesn't have to come up with the $50,000. She only have $150,000 in here. Using the $150,000, I think she can contract several contractors, talk to them, and see how much it costs to rebuild your house. Now, it may not be enough, but I think you can negotiate with them. I don't think a contractor will walk away from you for $150,000 of a project.
Okay.
I say don't take that chance, right? Because, you know, in loss assessment, like we talked about on the commercial or the master policies on all that, do you guys remember when I built my house 7-8 years ago. Do you guys remember that time where contractors weren't giving you bids past 30 days? Why? Because there was a great demand, correct? Right? What happens in natural disasters? Prices go up or prices go down? Am I as a contractor going to be willing to negotiate with you, or am I going to go to the highest person that's willing to pay? So let's just say Vanessa wants to negotiate with me, but Bob's willing to pay me $50,000 extra to build, and my time is limited. That's why there's an increase in cost when there's a natural disaster. That's why you have to have that extended limits, because we never know what the circumstances. It might be true that now people are willing to negotiate, but when I built, they wouldn't give me a contract past 30 days. And that was hard. It was really, really difficult. And that wasn't even because disaster was happening. That's because our market was booming. All right? So insurance is all about risk, and risk is all about risk tolerance. And if I could time it, then I say buy insurance whenever you have the claim, and don't have insurance when you don't have a claim. But none of us know when it's going to happen.
We're going to take questions in just a minute, but I have one other question to ask.
Ask
And we talked about homeowners, we talked about fire, condo, and you know, of course there's auto, but what other insurance is there that you find really most important?
Well, to me, of course, home insurance and auto insurance, those are important policy because the lenders on your back ask you to get it. The auto policy, of course, you need to protect your auto, and maybe you have a lender on that finance a vehicle. But to me, the most important policy actually is life insurance policy, because auto and home, you're insuring something. Life insurance policy ensuring your stream of income. Like me, okay, I'm the only breadwinner in my family. I got 4 children here. Now, every month I'm like ATM machine here. They come to here and they punch a number, and they come out here. So if this ATM machine is broken, money is not coming out. So who's going to
Broken, dead.
Dead.
Okay.
Expired.
Expired.
So who's going to take care of the children, my wife, and things like that? Okay. Now, I look at it as, let me tell you a story. Very short, okay? Very short. How about love story? Love story here. Yes. Once upon a time, there was a man and a young lady. Now, the man keep chasing after this young lady. Finally, the young lady say, okay, I want to marry this man because this man promised I'm going to take good care of you for the rest of your life and stand by you in whatever situation. So they get married and then they have children. Now this lady become a mom, take care of the kid, take the kid to go to school, fix the lunch, take them to soccer game, practice baseball, practice piano lesson, everything like that. And then do the laundry, clean up the home, go to the supermarket, prepare the dinner, everything like that, okay. Now, it can free up the man to go to work. Fast forward 20 or 30 years later, the man passed away. You ask the question is, what's there for the lady? There's nothing for her. All she has is, she dedicated her whole life for this man, for the family, sacrificed herself for the family. Nothing else. I see a lot of my friends, sometimes the man passed away, there's nothing for the wife here. So if I were to go first, to die first, I want to make sure that my wife can live comfortably. She doesn't have to worry about mortgage, expenses, things like that. So this young lady, as your wife, so make sure you have the life insurance.
I just want life insurance on my wife because I want to live good when she's
Okay, so if anyone has questions, please. There's no mic. Trump?
Yeah, you said the premium, the exclusion is 10 to 15%?
Yes.
Are there any policies that offer more than that, like 25 or 50?
No, I don't know any other policy that they offer higher than 15%. My thing on this here is don't get 10% because the premium will be higher. I would get the 15% of deductible, meaning that when there's an earthquake, I will still have a policy, I will still be covered.
A question about earthquake insurance. Show of hands by the panel here. Do you all have earthquake insurance? Okay. Question to the audience. How many people by a show of hands have earthquake insurance?
So it's about 20% of the California market.
Well, I saw a lot less than 20%. Hands being raised. So then the question is, you've got to convince us, because this is your business, why we should have earthquake insurance.
It's basically, it's not about convincing you to inform. Like I told you guys, you have 2 options if an earthquake happens. And total destruction. Walk away or find money to rebuild. If you don't have earthquake insurance, that's your only options, all right? So if you, and I think that's pretty convincing in itself. If you don't have the capacity to rebuild, then you better buy it, because your only alternative option is to walk away. Yes, Mario.
Solar panels are becoming the thing, and I would think in the next decade, for what I've been hearing, are pretty much in, are they gonna be covered? I already know in the areas of finance, if they're leasing is a problem, if they own. So how is that gonna impact now the regular insurance that they're buying? If I say install solar panels and something happens?
Solar panels included, right?
Solar panels included, right?
Me? I don't want to hug, I'm giving them the chance. All right, solar panel, it depends if you're the owner or if you're not the owner. For instance, I own solar panels. Unfortunately, it cost me quite a lot. I mean, it cost me almost 40 grand. Of course, I got rebates back. So what I had to do was ensure that, remember, if let's just say that she put, again, I'm using my Vanna White here, Vanessa, she put solar panels and it cost 40 grand, but I already factored in that her house is 500,000. I have to kick up the coverage to 540 so that I, as her agent, make sure that she has sufficient enough to pay back that solar panel. Now, she's leasing it. Many of your leasing programs, they're responsible for that. It's sort of in the leasing price. So she's not responsible for that. Does that answer your question?
Yeah.
Yes,
No, I hear that.
Oh, sorry.
Mark,
The panel.
the panel, okay. You have a 15% deductible. There is any insurance company out there which you can buy a policy for the 15%? No. 15% is usually the deductible, which what I'm trying to say, it's
I understand. You want to make up that gap. Is there a plan that you can buy out there that can make up the gap? And the answer is not that I am aware of. I don't know if Michael, you are aware of any.
So that's pretty. I don't think they have the other policy they can cover the difference. You know, they do have two options, 10 or 50% deductible. That's all they can get years two.
We only have 1 minute left, so who has a really good question? I saw the hand in the back.
The one that's sitting to the back.
Just have a two question. What is that? We have two properties, the State Farm, but it has California authorities who pay the insurance, two separate check, correct?
Yeah.
Yes.
Now, the two other properties, my husband pays more than that, I'm gonna do the earthquake off. So, I have to pay from different companies, just the earthquake portion has to be wherever he has it with.
You want to answer that?
You go ahead.
Can you repeat what she just asked?
I'll go ahead. So she has basically 3 policies with 3 different companies, and she asked if she can purchase earthquake. There are standalone companies that you can buy earthquake insurance through. Some of us represent that, meaning that you don't have to go to the CEA. But if you're with one of the major carriers, like the ones we represent, if you have to come back to us if you want to go to the CEA. So if you have insurance with Sam or Michael, you can't come to me to buy the insurance. Likewise, if you had my insurance with me on your homeowners, you can't go to them to buy the CEA earthquake. So you have to go back to the CEA. However, if you don't want to go back to the CEA and you want what we call a standalone policy, meaning a company that just offers separate earthquake insurance, then you are free to go with whoever you want. Does that answer?
CEA more expensive or the separate?
It all depends. There's not, you gotta evaluate each individual because there's so many factors and variables. Earthquake zones, liquefaction, meaning how's the stability of the ground and all that. So companies have so many variables. So it's just like if one company, I always say, was cheaper than the rest, then the rest of us wouldn't be here anymore. There's so many variables that make up pricing. And as I always teach my classes, don't shop on price alone because you'll get nipped.
Well, thank you.